In September 2008, the United States government looked at the wreckage of the global financial system and did something it had never done before. It decided which companies would live and which would die. Lehman Brothers was sacrificed. AIG was saved. The decision took one weekend. The consequences are still unfolding. This wasn't a natural disaster. It was engineered by very smart people with very complicated math, and it almost worked. Here's how the world economy broke in slow motion and why the people who broke it mostly got away with it. Let's start with a house, a physical house, wood, brick, mortgage payments. For most of the 20th century, getting a mortgage was difficult. Banks wanted proof you could pay them back. They checked your job, your income, your credit history. If you passed, they gave you a loan. Then they waited 30 years for you to pay it back. Boring, but stable. By the early 2000s, something changed. Banks realized they didn't have to wait 30 years. They could sell your mortgage to someone else, package it up with 1,000 other mortgages, turn it into a bond. Suddenly, your monthly payment to the bank became an investment product on Wall Street. This seemed brilliant. Banks could make loans, sell them immediately, and use that cash to make more loans. More fees meant more profit. The system was humming, but there was a problem. Wall Street wanted more mortgages to buy, many more, and America was running out of qualified borrowers. So the definition of qualified changed. Banks started offering mortgages to people with no income verification, no down payment, no credit history. These were called subprime loans, which is a polite way of saying they were given to people who probably couldn't afford them. The interest rates were higher to compensate for the risk. But here's the key. The banks didn't care if these people defaulted because they weren't holding the loans. They were selling them to Wall Street the moment the ink dried. Wall Street took these subprime mortgages and did something creative. They bundled them with prime mortgages, the good ones, and created a new product called a mortgage-backed security. Then they sliced these securities into different tiers called tranches. The top tier got paid first and was considered safe. The bottom tier got paid last and was risky. Rating agencies, the referees of finance, looked at these products and gave many of them AAA ratings, the same rating as US government bonds. This was insane, but it was also profitable. Pension funds, insurance companies, and foreign governments started buying these securities because they offered better returns than treasury bonds and had that beautiful AAA stamp of approval. Housing prices kept rising. Everyone believed they would keep rising forever. Homeowners refinanced and pulled cash out of their homes. Banks issued more subprime loans. Wall Street created more securities. The cycle fed itself. Then came the derivatives. If mortgage-backed securities were complex, derivatives were complexity squared. The most infamous was the credit default swap. Think of it as insurance on a bond. If the bond failed, the insurance paid out. Except it wasn't real insurance. There was no requirement to hold reserves, no regulation, and here's where it gets absurd. You could buy insurance on bonds you didn't even own. It was like buying fire insurance on your neighbor's house, then betting it would burn down. AIG, one of the largest insurance companies in the world, sold tens of billions of dollars worth of credit default swaps. They collected premiums and assumed the mortgages would never default in large numbers. They were wrong. By 2006, housing prices stopped rising. By 2007, they started falling. Subprime borrowers began defaulting, not a few, thousands, then tens of thousands. The bottom tranches of mortgage-backed securities collapsed in value, then the middle tranches, then the top ones. The rating agencies, who had blessed these products as safe, suddenly downgraded them to junk. Investors panicked. No one wanted to buy mortgage-backed securities anymore. The market froze. Banks that had relied on selling these securities to fund new loans suddenly couldn't. They were stuck holding assets no one wanted. Assets that were supposed to be worth billions were now worth pennies on the dollar if they could be valued at all. Many couldn't. They were called toxic assets, which is what happens when financial innovation meets reality. Bear Stearns, one of the oldest investment banks on Wall Street, collapsed in March 2008. The Federal Reserve orchestrated a rescue, essentially forcing J.P. Morgan Chase to buy it for almost nothing. This was unusual. The Fed doesn't usually save investment banks, but Bear Stearns was connected to so many other institutions that letting it fail could trigger a chain reaction. For a few months, things seemed to stabilize. Then came September. Lehman Brothers had survived the Great Depression. It had survived wars, recessions, and countless market crashes. It did not survive its own bets on subprime mortgages. The firm had leveraged itself 40-to-1, meaning for every dollar it owned, it had borrowed 40. When its mortgage assets lost value, there was no cushion. Lehman was bankrupt. The government decided not to save it. The official reason was moral hazard. If you bail out every failing bank, banks have no incentive to manage risk. Let one fail, the thinking went, and the market will learn a lesson. The market learned a lesson. Lehman Brothers filed for bankruptcy on September 15, 2008. It was the largest bankruptcy in American history. The next day, the entire financial system seized up. Credit markets, the invisible plumbing that keeps the economy functioning, stopped working. Banks stopped lending to each other. Businesses couldn't access short-term loans to make payroll. Money market funds, considered safer than savings accounts, started breaking the buck, meaning you could lose money. Panic spread globally. The government reversed course immediately. The next day, it bailed out AIG for $85 billion. AIG had sold so many credit default swaps that its failure would have triggered payouts across the entire financial system. It was too interconnected to fail. Lehman was sacrificed to prove a point. AIG was saved because the point had been made and the consequences were unacceptable. Over the next few weeks, the crisis metastasized. Washington Mutual collapsed. Wachovia was rescued. Merrill Lynch was sold to Bank of America in an emergency weekend deal. The government seized Fannie Mae and Freddie Mac, the two mortgage giants that backed half of all home loans in America. Then came the number, $700 billion. That's what the Treasury Department said it needed to stabilize the system. The Troubled Asset Relief Program, TARP, was supposed to buy toxic assets from banks. In practice, it became a direct injection of capital into the banks themselves. Some banks didn't want the money. They were forced to take it anyway, so the weak banks wouldn't be obvious. The stock market collapsed, unemployment spiked, millions of people lost their homes, trillions in wealth evaporated. And the people who caused it, the executives who designed these products, collected their bonuses and walked away. One executive went to jail. One. His name was Karim Sarageldin, a mid-level Credit Suisse trader who hid losses. The architects of the crisis faced no criminal charges. Some paid fines. Most moved on to new jobs. This wasn't an accident. Prosecutors struggled to prove criminal intent. The products were legal. The opinions were opinions. The leverage was allowed. The system was designed in a way that made catastrophic failure possible, but criminal liability nearly impossible. Here's what makes 2008 different from every other financial crisis. The people in charge understood what they were doing. They had PhDs in mathematics. They built models. They stress-tested scenarios, and they convinced themselves and everyone else that they had eliminated risk. They called it financial engineering, as if you could design an economy the way you design a bridge. But economies aren't bridges. They're made of humans, and humans panic. The crisis ended, technically, in 2009. The economy recovered unevenly. Banks were recapitalized. Regulations were tightened. then loosened again. Housing prices eventually rebounded and then surpassed their pre-crisis highs. If you owned assets, you did fine. If you didn't, you fell further behind. We learned some lessons. We forgot most of them. Lehman Brothers is gone, but the incentives that created Lehman still exist. Banks are bigger now than they were in 2008. The too big to fail problem wasn't solved, it was institutionalized. And the derivatives market, the exotic financial products that amplified the crisis, is now larger than it was before the crash. So here's the question we still haven't answered. What happens next time? Because there will be a next time. The system is designed to grow. Growth requires leverage. Leverage creates fragility. And fragility eventually breaks. The 2008 crisis proved something uncomfortable. The global financial system runs on trust. And when that trust disappears, everything stops. Governments can print money, they can buy assets, they can rescue banks, but they can't print trust. In 2008, we came within hours of ATMs shutting down, of money itself becoming worthless, at least temporarily. We pulled back from the edge, barely. The real question isn't whether we learned anything from 2008. It's whether we'll remember it when it matters.